The world of cryptocurrency is facing another significant challenge, as a recent scam has reportedly defrauded investors of over $14 million. This situation underscores the ongoing risks associated with digital investments, especially as fraudsters increasingly leverage technology to exploit unsuspecting individuals. On December 24, 2025, the U.S. Securities and Exchange Commission announced charges against several companies, including crypto trading platforms and investment clubs. These entities allegedly lured retail investors through social media ads and deceptive group chats, where they posed as financial experts offering AI-generated investment advice. In this video, we'll break down the details of this elaborate scam, explore how it operated, and discuss the implications for investors navigating the crypto landscape. If you found this update helpful, please like, share, and subscribe to InfoSec Now for the latest cybersecurity news. Your support really helps us continue building useful content for cybersecurity professionals. Timeline of the scam, how it unfolded. The scam began to take shape around December 2023 with the establishment of Morrocoin Tech Corporation, one of the key platforms involved in the fraudulent scheme. This was followed by the launch of Berga Blockchain Technology Company, Limited in June 2022 and Circa Incorporated in May 2024, each presenting themselves as legitimate trading platforms. By January 2024, the operation escalated as AI Wealth and Lane Wealth initiated their investment clubs on WhatsApp, using social media ads to attract retail investors. These groups created a semblance of legitimacy, with self-proclaimed financial experts, referred to as professors, disseminating information about macroeconomic trends and stock market insights. This tactic fostered a false sense of trust among potential investors. As the scam progressed, the clubs began to promote security token offerings, STOs, for fictitious cryptocurrencies, such as SCT from the non-existent Satcomtech and HMB from Human Block, capitalizing on the allure of AI-generated investment tips. These deceptive offerings were designed to entice individuals into investing substantial sums of money. Throughout the operation, the scammers maintained a facade of professionalism, with daily interactions managed by assistants who engaged with investors, further solidifying the illusion of a legitimate investment opportunity. However, when victims sought to withdraw their funds, they were met with additional demands for advance fees, leading to a second wave of financial loss. The financial trail of the scam reveals a complex web of transactions, with at least $14 million being funneled overseas through accounts linked to individuals in Southeast Asia. Investors unwittingly transferred large sums, such as over $1 million to Chinese accounts and more than $1.4 million to a bank in Indonesia, highlighting the extensive reach of the fraud. By January 2025, the scam had reached its peak, ultimately resulting in the administrative dissolution of Circa Incorporated in October 2025. In the wake of these events, the SEC's charges were filed, marking a significant step in holding the perpetrators accountable and aiming to recover the misappropriated funds for the affected investors. The case serves as a stark reminder of the vulnerabilities present in the digital investment landscape and the persistent threat posed by sophisticated scams. The fallout from this $14 million cryptocurrency scam has left a wide array of victims, primarily comprising retail investors who were lured by the promise of lucrative returns from AI-generated investment tips. Many of these individuals are now grappling with significant financial losses, some reportedly losing life savings or retirement funds. The psychological toll is also profound, as victims face not only monetary loss but also feelings of betrayal and distrust towards the financial system. The scam's operation through popular messaging apps like WhatsApp allowed fraudsters to create a facade of legitimacy and community, which further ensnared unsuspecting investors. This strategy fostered a sense of belonging among victims, who believed they were part of an exclusive group receiving expert advice. As a result, many were reluctant to question the motives of the so-called professors and assistants who were actually orchestrating the fraud. Moreover, the impact extends beyond individual investors. It raises alarms within the broader cryptocurrency market, which is already under scrutiny for regulatory compliance. The involvement of multiple companies and the sophisticated methods employed by the scammers could lead to increased regulatory scrutiny across the industry. This situation may deter potential investors, contributing to a chilling effect on legitimate crypto ventures and innovation. Additionally, the scam has implications for international financial relations, as funds were funneled through various overseas accounts, complicating recovery efforts. Law enforcement agencies may face challenges in tracking these illicit funds, especially given the global nature of cryptocurrency transactions. The SEC's pursuit of civil penalties and injunctions highlights the urgent need for regulatory frameworks that can adapt to the evolving tactics employed by fraudsters. Finally, this incident has ignited discussions around the necessity for enhanced investor education, particularly regarding the risks associated with cryptocurrency investments. Financial literacy initiatives could play a crucial role in equipping potential investors with the tools to recognize and avoid similar scams in the future. The overarching message is clear: as technology evolves, so too must the strategies for safeguarding investors against fraud. The SEC's response to this extensive scam involves a multifaceted approach aimed at both accountability and prevention. Following the charges, the Commission is focusing on securing permanent injunctions against the involved parties to prevent further fraudulent activities. This includes seeking civil penalties that could serve as a deterrent to other potential fraudsters in the cryptocurrency space. Moreover, the SEC is emphasizing the importance of investor education as part of its strategy. By raising awareness about the tactics used by scammers, such as the manipulation of social media and messaging apps, the SEC hopes to empower potential investors to recognize red flags and avoid similar traps. This educational initiative may involve collaborations with financial institutions and advocacy groups to disseminate information more effectively. In addition to pursuing legal actions, the SEC is likely to enhance its surveillance of cryptocurrency platforms and investment clubs. This could involve more rigorous scrutiny of new entities entering the market, especially those claiming to utilize advanced technologies like AI in their investment strategies. By tightening regulations and monitoring compliance, the SEC aims to create a safer investment environment. The Commission's actions may also lead to broader discussions about regulatory reforms in the cryptocurrency sector. Given the rapid evolution of digital assets, there are calls for clearer guidelines that can adapt to new technologies and investment models, ensuring that both investors and legitimate businesses are protected from malicious actors. Finally, the SEC's commitment to transparency will be crucial in maintaining public trust. By providing regular updates on the progress of these cases and sharing insights into ongoing investigations, the Commission can foster a sense of accountability that resonates with the investing public. This approach not only addresses the immediate crisis but also lays the groundwork for a more resilient financial ecosystem in the future. If you found this update helpful, please like, share, and subscribe to InfoSec Now for the latest cybersecurity news. Your support really helps us continue building useful content for cybersecurity professionals.